We're okay to lose customers on purpose is a bold statement to make. And it's even bolder when your stock has fallen nearly 60% from its peak. Last week, Swiggy CEO Sriharsha Majeti sat down with Bloomberg and made exactly this case. You see, Flipkart and Reliance are currently in a full scale spending war to deliver groceries to you under 10 minutes using discounts after discounts and opening one dark store after another. But Majeti said that Swiggy would sit this one out. Instead, he said that the company is willing to shed some users in the short run to hold on to the ones who are loyal and make the company profitable. To explain why, he cited the example that a senior Airtel executive had recently shared with Swiggy's own leadership. When Jio triggered a price war in telecom, Airtel chose economics over subscriber count. Many competitors disappeared or consolidated, but Airtel held its position. It is a clean analogy, and honestly, it does sound like a vision. But he also said something else that didn't get as much attention. Majeti told Bloomberg, if we lose, capital will not be the reason to lose. I say that also because I have 15,000 crore rupees in the bank. So, this is not a company pulling back because it's running out of road. Majeti is basically arguing that this is a deliberate choice. But Swiggy invented this category. Instamart launched in 2020, a good 2 years before Zomato even acquired Blinkit. In the financial year 2022 and 23, Swiggy's revenue was nearly 1,000 crore rupees higher than Eternal's, which is Zomato's parent company. So the head start and the advantage were very real. But today, Blinkit has twice as many dark stores and more than twice as many monthly users. Its net order value has grown 7 times since early 2024. Instamart's, on the other hand, has grown less than 4 times. Losses at Swiggy widened by a third to over 4,000 crore rupees in the financial year 2026. In fact, JM Financial, a brokerage and a financial services firm, valued Instamart at precisely zero in April this year. So here's the thing. You see, when Airtel chose restraint, it was an incumbent that was making a calculated bet from a position of strength. So, the question that Majeti's interview leaves hanging, and the one that we will try to answer in this episode, is whether Swiggy is making a strategy or is it actually just making peace with a position that it has already found itself in? Welcome to Daybreak, a business podcast from the Ken. I'm your host Snigdha Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that is worth understanding and worth your time. Today is Tuesday, the 2nd of June. Conventional wisdom says that when a company goes public, the pressure to perform sharpens. In November 2024, Swiggy listed on the Indian stock exchanges. The IPO was a landmark moment. Over 500 Swiggy employees saw their wealth transform in a single day. By comparison, when Zomato, Eternal, went public in 2021, it made around 20 people dollar millionaires. Senior Swiggy executives, speaking to my colleague, the Ken reporter Suprit Anupam, described what had happened in the months after the IPO. Many employees, newly wealthy, settled into their comfort zones, and many were elevated to the VP level. But their performance kind of stayed flat. The company had reshaped its leadership just before the IPO, bringing in Amitesh Jha, a Flipkart veteran, as the CEO of Instamart, and Sai Ram Krishnamurthy as the COO, though Krishnamurthy left in 2025. Madhusudan Rao had taken over as the Chief Technology Officer, and Rohit Kapoor took the charge of food delivery and dine out. In fact, Majeti himself had previously overseen food delivery. Co-founder Funny Krishnan Adepalli had run Instamart. So all this restructuring was basically meant to signal focus. One executive, though, told the Ken quite bluntly, The IPO delayed our product launches and slowed down our growth curve. Many product approvals were delayed citing the IPO. Eternal founder Dipinder Goyal had faced a version of this after his own IPO in 2021. He described it openly at an event. Competent people making money for the first time and then losing their drive. Goel's response to this was clear the house. He removed everyone who had grown complacent. Swiggy's version of the same story landed harder. More millionaires and more comfort and less urgency. The results are visible everywhere you look. Instamart's spending per order has actually gone up, but the number of users it's adding each quarter, barely a trickle. Blinkit, on the other hand, added as many new users in one quarter as Instamart managed to add over 15 months. And when you look at how much money is actually flowing through each platform, Blinkit has grown roughly 7 times over since early 2024. Instamart has grown less than 4. Then there is also the problem of the app. Swiggy built an all in one app, food delivery, quick commerce together. But it records fewer downloads than Zomato and Blinkit standalone apps individually. A Deloitte consultant put it quite plainly. They said there is a gap between how Swiggy communicates with existing users and how it reaches new ones. The super app has never been marketed as a super app. Actually, all of this ultimately boils down to a pattern that runs through Swiggy's history. More on that in the next segment. So here's the pattern. Swiggy spots an opportunity quite early, earlier than its rivals, and then it enters that space. But when the moment comes, when it matters the most, Swiggy hesitates. Quick commerce is actually the clearest example of this. Blinkit was struggling when Eternal acquired it in 2022. So Goel decided to pour in money into dark stores without even thinking twice, adding more stores in a single quarter than Instamart had added all year. Today, Blinkit has roughly twice as many dark stores as Instamart and stocks nearly 60% more product categories in Tier 1 cities. The same pattern shows up in the out of home segment. Swiggy has Dine Out for restaurant reservations and Scenes, its events platform. Together, they are EBITDA positive, but their combined revenue in FY 2026 was 375 crore rupees. Eternal's District, its competing platform on the other hand, has hit almost 1000 crore rupees. Even in the quick food delivery, Swiggy launched Snack, which is a rapid food delivery service, but it shut it down within a couple of quarters. But competitors like Zepto Cafe, Eternal's Bistro, and the startup Swish, which just raised a new funding round, are still running. Another example is Swiggy's latest attempt called Toing, a budget delivery service with the tagline lowest guaranteed price. But its budget positioning aimed at metro consumers is a little bit confusing. Eternal CFO Akshant Goyal said publicly that he could not understand what problem Toing was solving for customers or even restaurants. Satish Meena of market research firm Datum Intelligence put the strategic gap plainly. Blinkit, he says, has identified its consumers, which is urban households that prioritize convenience and will pay for it. Amazon now is targeting Tier 1 and Tier 2 cities. Flipkart Minutes wants smaller cities. But Instamart's target customer remains undefined. JM Financial, the brokerage, valued Instamart at precisely zero in April. And it went further, suggesting that the company would be better off acquired by a larger rival. Now, most analysts that the Ken spoke to pushed back on this. But the underlying concern still holds. Swiggy still has the brand and the reach. Analysts say that the company's current focus on contribution margins, which is trying to get Instamart to break even on each order, is wrong priority at the wrong time. The quick commerce market is still expanding. Product market fit is still evolving, and as one analyst said directly, growth and more growth is the only way forward. Now, Swiggy's earnings call last month was meant to project more clarity on this. but most people walked away with something else entirely.
Daybreak is produced from the newsroom of The Ken, India's first subscriber focused business news platform. What you're listening to is just a small sample of a subscriber only offerings, and a full subscription offers daily, long form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.